I think silver is still in that process. And frankly, I think the 3 to 500 will occur. And once we come up out of this congestion, and I think we're in the process of trying to do that right now, as it happened to be today, this interview is occurring, we're crossing some numbers on silver and gold that tell us, this rally is going to be different.
In which case, this becomes the long-term low. And then we start our next bull move that started in 2021. And then listen, I mean, and then there's the history of it, right? And if we get a repeat of this, then, I mean, think about this, $250, $500 silver. I'm not going to pretend to know that yet. I'll have to get closer, but isn't that fascinating? So essentially over here, folks, what we're doing here is we're saying, maybe a little bit of a move like this, and then we get our last move down, then a lot of sideways kind of choppiness, and eventually we start our next leg up.
The precious metals market is currently navigating a prolonged consolidation phase that has shaken out impatient investors. Despite temporary price stagnation, major underlying macroeconomic factors point toward an imminent structural bull market expansion. Michaeloliver, a leading momentum analyst, and Gareth Soloway, a veteran chief market strategist, contend that current silver valuations represent an unprecedented pricing anomaly across hard commodities. While key industrial metals like copper, lead, and zinc trade at 4 times their 1980 peaks, silver remains artificially suppressed near historic baseline levels. This structural disparity creates massive stored coiling energy that must eventually unleash a violent upward breakout. Once silver overcomes current range-bound congestion, technical momentum signals a rapid price re-rating. They forecast that this technical breakthrough will trigger an explosive rally, launching silver directly into the $300 to $500 price range as true market value is restored. Now, we present the clips from their interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
We expected in the middle of the explosion that silver would have a correction, likely one that scared people. It came much sooner than we thought. We thought it might be March, April. You get your sharp break and then you continue up. Instead, it's been deeper and more protracted. But actually, if you stand back and look at gold and silver on a simple weekly price chart, let's say, you'll see that 90% plus of the damage that was done in the break occurred within the first handful of days. January 30th collapsed, opened up February 3rd, and into the first week of February, there was a low. Gold hit 4,400, and silver hit 64, actually 63.90. Where are we right now? Trading 60 plus, okay? So 6 months later, after early February, 6 months later, early August, we're trading several dollars lower than we did in early February. And gold is trading about 8% below where it was in early February. So the break really was a phenomenon measured in hours, a few trading days. Since then, what has demolished the psychology of any investment grade longs in the monetary metals is the time spent and the rallies that go back up, but they don't seem to take hold. And yet, every time we make a new low, like in March, the war sell-off, we took out both lows. Silver took out the $64 low. I think it went down to around 61. Gold took out its $4,400 low of early February, went down to 4,100, and then rallied again. So every time we make a new low, since the February low, it's marginal, and it doesn't sustain. In other words, you run the stops, so to speak, that, there's an obvious low, let's take it out. Okay, took it out, nothing much happens, you rally. But the rallies also don't seem to go to sustain. But still, in reality, we are trading now $3 below silver is 6 months after the collapse, which ended in the first week of February. Okay, gold, a similar situation. So really, the decline was then, and since then, it's been wear them out. So you've worn out, especially the latecomers, people who bought at the wrong time, and point of entry is always important. Like MSA put out 3 major buy signals in the last several years. One was at $25 silver in March of 25. One was at $35 silver in June of 25. And one was at $56 silver in November's close of 2025. Those were our entry points. Not $100, not $110. So people who came in late and chased the trend got killed. And of course, now the story is, oh, it's no good, it's going down. There are all kinds of problems with that assumption. Too many people are looking back on prior highs in silver and gold on an arithmetic scale and saying, oh, it looks like the peak that occurred back then. Oh, it looks like the peak that occurred back then. And whoa, we laid in the weeds for 2 years after that. We're not in the same situation. The global economic monetary situation is at the point of a nuclear event. The monetary metals are cheap. They're going a lot higher. Gold is nowhere near the bull markets that it produced in 1980, or the bull market it produced in 2011 in terms of the percentage gain of the bull market. We're only half as much as those bull markets were. Eightfold gain. We're only fourfold above the bear low in gold, which is 1,050 back in 2015. Pardon me if I get long-winded. There's another smack in the face point that everybody should think about. And we know that Eric Sprott has argued, and many other people have argued, that the silver has been manipulated. For whatever reason, it's something is going on there to try to restrain it. And if you want evidence of it without the actual courtroom evidence, there's been a few cases, I understand. Think about this. The price, we ran these charts in a report back middle of last month. We showed the price of lead, steel, zinc, aluminum, copper, and gold going back to like 1980. Each of those metals right now is trading about 4 times higher than where it was in 1980. Gold is, 4,000, 4,100. It's low back then, and its high back in 1980 was 850. You multiply it, it's more than fourfold, almost 5. Why is silver trading 10 cents above its 1980 high? All the metals made highs around then, and yet most of them are fourfold higher than that. And yet silver's 10 cents, $10 above its $50 high in 1980. What the heck is going on? That ought to smack people in the face, that reality. If it's been restrained, and is it a price level it shouldn't be at, meaning too low for too long? Often when markets make mistakes, they go berserk the other way to compensate for the error they made before. Too high price for too long, they collapse. Too low price for too long, they explode. They don't behave normally. And I think silver is still in that process. And frankly, I think the 300 to 500 will occur. And once we come up out of this congestion, and I think we're in the process of trying to do that right now, as it happened to be today, this interview is occurring, we're crossing some numbers on silver and gold that tell us, this rally is going to be different. It's not just going to be another fumbled rally within the range. If that's the case and we move up out of this congestion, I think silver will go berserk, period.
Historical price chart cycles consistently demonstrate how market behavior repeats, because human trading emotion remains constant across decades. Analyzing current silver price action against the 2011 cycle reveals striking structural similarities, characterized by sharp flush moves, temporary corrective bounces, and technical retests of major breakdown levels. The technical structure suggests silver still faces short-term downward pressure, pointing toward one final corrective shakeout toward the $50 target zone. Rather than indicating a long-term structural failure, this expected final dip will establish a firm, durable base plate. Once the market completes this bottoming sequence, historical cycle projections indicate the start of a multi-year macroeconomic bull trend, with price targets conservatively projected between $250 and $500 per ounce. Now, let's get back to the interview.
Now, if we flip over to silver, silver continues to kind of languish here. You had this kind of down move, sideways, 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 and break, and now sideways again, and it continues to signal weakness unless we take out this level here. Okay, now, what I wanted to show you on this is if we take away these trend lines, right, and we split the screen, and we look at the various cycles here. So here's our current cycle on silver, right? Our blow off top, massive blow off top. And I kind of did this for gold last week for you guys, but it is fascinating to look at silver. If we go back on the cycles, right, and we go all the way back here, and we look at our 2011 cycle, this is fascinating. It is very, very, very similar to what we are seeing in silver now. And because of that, it can give us some insights into potentially where we're going in the near term. Okay, so let's go through this here. All right, so number one, you have the bull move with the little check back. and then the bull final move up. And if we look at this current cycle that we just went through in late 2025 into 26, it checked back and then it went up. All right. So this was in 2010 into 2011's peak on silver. Okay. So we have that. Now we extend that out and we say, okay, well, initially we dropped, bounced, and then we came down. And here you did have a much more just steep. I mean, you had this little bit of an uptick right here, and then the down move came down here. So similar, this had a little bit more of consolidation going on before that flush out. But either way, you ended kind of in alignment here, right? So in other words, you can see how, and I'm just going to clean up the chart a little bit here so we can keep it simple, is that essentially what we started to form was this base plate right here in basically in 2011 to late 2011 into 2012, et cetera. All right, so the point is right here. There's your base plate. And then what we could see here is you literally had the same thing. So you had the flush. So here's our flush, bounce, flush, and then bounce. And here you have your flush. Oops, let me do that better. Flush, bounce, flush, bounce. And notice how it's all going along this zone here. And here we have, at our current levels, we have the same thing going on. Look at this. Here's your flush, bounce, flush, bounce, flush, bounce, break. And then look at how, just like here, hitting it over again, break, and then it goes to a retrace of the scene of the crime. You hit it here, hit it here, hit it here, broke, retrace to the scene of the crime. Now, what that tells us is that this peak here is the equivalent exactly in the cycle of this peak right here. So then we're getting close to where we currently are on the peak, right? So let's move this out. And what we see here is that almost identical, you get this move up, you get this move down, you get this little move up, then you get this little move down. And if we look at that, here's your move up, down, up, down. This is right where we are now in the cycle. And so what we see here is there might be a chance at another little bounce, right? There was a little bounce here. And then what happened to silver? It had its next leg lower. And that's the leg lower that, in my humble opinion, is going to take us to that $50 potential target. Now, listen, I want to be crystal clear on this, is that cycles don't have to be exact. And as we see, even on this, it generally rhymes, but it's not tick for tick, right? It's not tick for tick. And so we have to just be understanding that this is one projection that could happen, but there's no guarantees of it, right? And so we have to be open to things. Like if we were to break above some key levels, all of a sudden that changes the game and now we have a breakout. Right now, we don't have that on silver. And so we have to be cognizant of that and be very aware. But essentially, what's cool about this, folks, is that if it has, essentially it has played out almost perfectly as the 2011 cycle has. Now, by the way, you might say, well, why is it playing? Why do cycles repeat generally? Like, why do they rhyme at least? Maybe not repeat perfectly, but rhyme. And the answer is because humans are the ones trading. And as much as I may be, I'm still human. I still have a little emotion. Yes, I've gotten major control. But if you look at 1 million people that are trading silver or gold, or 100 million or whatever it may be, they are going, emotion is emotion. It doesn't matter if it's 2011 or 2026 or 1980 or 1500. Emotion is the same. People were still greedy and they were still fearful. And that's why this works so well. And listen, again, it's not perfect. And I think we have to be honest about that, but it is fascinating. And so essentially what we're looking at is silver likely has a little bit more downside. But if we zoom out, generally this became, I think we went a little bit lower overall and it took some time, but that was essentially it. Like if we look at this is kind of that last dip to 50 or maybe just below 50. And then, yeah, you had a flush here. This was COVID. I'm not sure, we'd have to say, oh, well, you have to have another COVID to kind of do that. I don't think that's going to happen, in which case this becomes the long-term low. And then we start our next bull move that started in 2021. And then listen, and then there's the history of it, right? And if we get a repeat of this, then, think about this, $250, $500 silver. I'm not going to pretend to know that yet. I'll have to get closer. But isn't that fascinating? So essentially over here, folks, what we're doing here is we're saying, maybe a little bit of a move like this, and then we get our last move down, then a lot of sideways kind of choppiness, and eventually we start our next leg up.
The global monetary and financial architecture is rapidly approaching a critical tipping point that will fundamentally reshape physical asset valuations across global financial markets. When artificial market forces suppress commodity prices far below true fundamental equilibrium for extended periods, the eventual correction rarely occurs gradually. Instead, asset prices tend to violently explode upward to compensate for long-standing pricing inefficiencies. A broader historical perspective highlights how deeply undervalued precious metals remain relative to past secular bull market expansions. During major historical rallies in 1980 and 2011, gold and silver delivered massive eightfold gains from their cyclical bear market troughs. In contrast, current valuations sit at only a fourfold increase from structural lows, confirming that the broader secular bull market has significant upside potential remaining. Although technical charts allow for a short-term downward flush toward key support levels near $50, this temporary weakness will mark a generational long-term bottom. Once prices break free from immediate trading congestion, silver is predicted to launch into a parabolic rally, driving long-term valuations between $250 and $500 per ounce as monetary supply forces realign market prices. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.